Please remember that all content discussed on this show is for educational and informational purposes only and should not be considered personalized financial, investment, or tax advice. The views expressed by our host and guest are their own and may not reflect the official position of DAG Wealth. Always consult with a qualified financial professional before making any investment decisions. Enjoy the episode.
We're back again with another fantastic episode for you guys today. Thank you again for taking time to watch the channel. Please like, share, subscribe if you do get value from this content. We'll go ahead and jump into it. Today we have another fantastic guest with us. He is the CIO for Digital Ascension Group and the wealth management side over there. But Lewis Sue is who I have here with me. Lewis, appreciate you being on the podcast.
Thank you, Jake. Happy to be here.
Absolutely, dude. So thank you for coming over. And this is kind of a recent deal. You know, you haven't been here that long. And I wanted to give people perspective on just who you are and your expertise and background in the industry. Would you mind giving people, you know, your synopsis of what led you to end up working here?
Yeah, that might be a long one, but yes, let me give that a shot. So
Give
I
it to
will
them.
go back. I'll go back to my college days, if you don't mind. I was
Yeah.
studying mechanical engineering, not very unlike Tom Thiel, our head of financial planning, if you will. He did electrical, so we have a few things in common, but really math and science oriented, and got super interested in finance. I was reading, books on growth investments in chemistry class, for example. That led me to a second major in finance, and then a master's in finance right after that. Graduated around the time of the financial crisis. That was really interesting. I wanted to be a quant, study math and engineering in finance. So wanted to go to Wall Street, but it just wasn't the right timing. But luckily, I landed at a institutional consulting firm that eventually got bought out by Mercer. This is in St. Louis. I went to Washington University and spent 2 years there doing hedge fund manager research, meaning taking a look at hedge fund managers in traditional finance, their exposures, how to allocate to certain hedge funds and whatnot. What was really interesting about that, Jake, was they were blowing up, obviously, back then in 08, 09. And they used to just fax things once a quarter, of their exposures. They wouldn't even tell you what's in there. So this was crazy, right?
Holy
That was that was normal back then. But that really opened my eyes into, the world of hedge funds. But as luck has it, I bumped into some folks in the indexing world. The guy who created the Russell series of indices in the
Oh,
Seattle
wow.
Tacoma area in Washington. Yep. The creator of those series, his name is Kelly Houghton, still around. He created this in 1984, I believe, because he was knocking on S&P stores and Wilshire back then. They couldn't, they didn't want to work with them. I think, benchmarking is a really important thing. We all think of S&P 500. We know what it is. It's the largest 500 names. Why does it exist? What exists to measure, stocks in a market? And back then in the 80s, a lot of managers were beating supposedly large cap benchmarks just because they're going to small caps, right? So he did the right thing. He created his own suite of indices, and the rest is history. So we do refer to the Russell 2000 as the kind of small cap benchmark to this day. But I bumped into him in the Seattle area and switched from alpha hedge fund manager research to indexing and try to build a startup with them to be the next S&P or Russell or FTSE, and that was really really cool. But after about a year of that, I needed to make some income, and that led me to BlackRock. So I was the youngest at 24 portfolio manager on their passive or indexing team, managing index funds and whatnot there. At that time, this is 2011. They had about over $1 trillion in assets just in non-ETFs alone. In my team of 9, we manage about 650 billion. So that's probably 2 or 3x by now. We all know, I think recently, BlackRock total crossed over about 15 trillion. So I went from alpha to beta to passive investing. And then I also went to Franklin Templeton to do the same thing. I was part of the founding team to manage ETFs there. Did a short stint at another wealth advisory firm in between there and here. But mostly right before Digital Ascension Group, I spent almost 5 years at Grayscale. So crossing over from traditional finance, alpha, beta, to crypto, and now wealth management. Again, very excited to be here, Jake.
Well, yeah, I think you have a wide variety of experience, and this is the cool part about what we get to do here is kind of marry traditional finance with crypto, right? Like build innovative products where not necessarily wrapping the same wrappers around crypto, but using those as tools and how that works with crypto to be able to scale things and generate products and other solutions in the market. So, like, would you mind giving me how you see the current market, where the status of things are at? Like, are we on the precipice of institutional adoption here in 2026? Or where do you see us, or what does the landscape look like to you?
Yeah, great question. So you and I both know that the ethos of crypto early on, especially for Bitcoiners, um, was completely the opposite of institutional adoption, right? It's all about decentralization and
Right.
immutable ledger and all that, right? Digital gold narrative. Obviously, that landscape has changed over the past 5 years or so, right? With the administration change and with a new SEC chair, et cetera. So I think if you are one of these OGs, you may not subscribe to the idea that institutional adoption may be good for the
Yeah.
adoption or the underlying technology itself. But I view it differently, like you and a lot of others here and our clients. We believe that the adoption is a catalyst for the asset class, right? It used to be the case that advisors were afraid to talk about even cryptocurrencies or digital assets, just a few years ago under the old administration because the rules were not clear. But that has flipped on its head. Right now, it's if you're an advisor and you have no view or no understanding or education about this asset class, that's actually doing a disservice to your clients. It's okay not to allocate to crypto, just like it's okay not to allocate to gold. Some people don't like gold because it doesn't produce cash flows. But more and more, what we're finding is that we are one of the few, and potentially the only shop that is, laser focused on servicing the crypto community of clients who understand that this is an asset class that is only growing with institutional adoption, and that can come in many forms, including the ETFs that came about in early 2024. In fact, January 11th, because I remember at Grayscale that day, it was up at 3, 4 a.m., seeing the first trades fire off pre-market. But there was a lot of things that we accomplished at Grayscale to make that happen. But no, to answer your question, institutional adoption, we are early to mid stages here, right? The Clarity Act, we're still waiting for. Let's all hope that that works through at the Senate this year. There are many predictions around that. But even without that, the SEC, the CFTC, they're working well together these days. We'll be able to put out joint rules.
Yeah. I with the new administration change and the change in the people at these agencies that they have the oversight, and there needs to be oversight on this asset class that's been neglected for a long time. And I'm, for one, and obviously we're biased because of the industry that we're in and what we do. But even as a traditional investor in crypto, if you don't have rules around this, there's just been so many people that have lost money, similar to what you're talking about with the hedge funds in the 80s, right? Like, when there's not disclosures, when things aren't transparent, when you don't understand how the yield's being generated or what your assets are being put into, or how it, what the risks are when you're participating in these things, it becomes difficult to quantify that and then determine if it is something you should even touch. A lot of people just stay away from crypto. And to your
That's right.
point, advisors, because they can't quantify the risk, they don't understand the asset class, or they're, they're not even going to allocate to it. It's not even a conversation that they will have. They'll just say, you should probably sell that and move it into these TradFi assets that I would have purview over and understand and consult with you on. And so, I think we're at a really pivotal point in time right now in 2026, where we're going to see a Cambrian explosion in the back half of this year with institutional adoption for the use of these networks and protocols, not necessarily the investment in the assets themselves. I think that will be a byproduct of the adoption of the technology, that we will see huge inflows and liquidity have to move into certain ecosystems for that to facilitate value transfer, back end settlement, smart contracts, the oracles, everything that provides additional benefit for those that are participating, both the institutions and retail and other enterprises want these things. They want money faster. Everybody wants
That's
to get
right.
their money faster.
That's right.
And you also want the same protections of being able to recover it if something goes wrong. I think everybody's probably you've sent crypto somewhere and you're biting your nails if it's Bitcoin for 45 or 50 minutes until it settles on the other side. XRP is a little bit faster than that. And you have
Yep.
a traditional wire, years ago it would take a couple days before
Right.
money would show up on the other side. Now
And
it's pretty quick.
it could be a week if you're international. Yes.
Right. So, with the internet and how fast you're able to get information, you would think that value and other stuff would have kept up with that. And I think that's the transition we're going to see in the back half of the year. So, on a look forward looking basis, what do you see for the back half of this year and really the rest of the decade for institutional adoption of these protocols and the assets themselves? And how do you see us playing a role in that?
Yeah, great question, Jake. Maybe before I get to that point, Jake, you first talk about risk. If you don't mind, I'll kind of
Sure,
address
please harp on it.
it head on. There are many, many risks, and I joke with our advisors here that I always talk about risk first, right? And it's not return first, it's the other way around because with cryptocurrency, it's a new asset class that a lot of people, frankly, don't understand. And they're just like putting their hands up, hey, I'm not going to touch this because I'm not sure what to make of this. Early on, obviously, years ago in the early days, there weren't really that many exchanges around for people to access this asset class. And you had to go to different places and maybe even mail, like you said, money or wire money offshore to get into cryptocurrency, right? Um, and that is not too dissimilar decades ago. If you think about this with gold, right? Before the gold wrapper of an ETF came about, it just isn't that easy to access that asset class. It's clunky, right? You got to, talk to jewelers. You got to access that in a
Wouldn't you?
different way. And exactly. So I think of that very similarly, right? Gold, it was just a physical instance. Bitcoin, digital gold, and other cryptocurrencies like Ethereum, Solana, XRP, in the digital sense, that it's just very hard to access. But with the advent of exchanges, certainly Coinbase in the US being a public company over time, it just got easier and easier democratizing that access. Now here, Digital Ascension Group Wealth, we help our clients not only access the asset class, but with institutional grade custody and trading. So it kind of de-risks and reduces the risk of the people losing either access to those coins or cryptocurrencies. But risk shows up in many other forms, especially if you're doing DeFi, decentralized finance activities, or bridging. There's been about a lot of hacks in the last few months. But beyond all these things, in the traditional sense, you've got counterparty risk that everything that we do rely on vendors for, that we make sure we address. We work with Anchorage, is a very institutional quality player in terms of keeping qualified custody cryptocurrencies. But to your question about the future, we're already seeing this and didn't really need to have waited for Genius Act to pass last year on stablecoins. But jointly, the CFTC and SEC have put out great guidance on what certain assets are commodities versus securities. That's not the full-blown Clarity Act that might be coming, but that has helped many firms to cross over from traditional to crypto. Right? We're basically, the main point here is we're going to see a blending or collision of the TradFi and crypto worlds. And in a few years, we're probably not going to say this is crypto anymore and this is TradFi. It's analogous to when the internet came about, where it took a long time to even with dial-up get on the internet, right? That was the thing back then. And some people here, if you're under a certain age, you have no idea what that means, but it took a while to just dial up and get on the internet, and that was crazy. But with same thing with crypto, right? The rails are building right beneath our feet. Most people, the average person, they're probably not going to even know or think about this. It's just going to be on your phone, whether it's a Robinhood chain app, whether it's a Coinbase one, whether it's a crypto native one. It's just going to be there. And the infrastructure, while it's exciting for the likes of us to talk about the adoption and whatnot, the average person may not notice it. And that, I think, will be a point of success for the industry when this is all abstracted. Now, again, the big difference, though, between the internet and now for crypto is that you could not invest in the internet. at the protocol level. You couldn't
Right.
invest in TCP/IP, that protocol. No one knows what it is, but it's just there. That's the kind of the rails of the internet. But in crypto, you still can, right? So there's still a lot of opportunities potentially for clients for investments.
Yeah, people don't think about the email protocol. That's an analogy that I
Right.
provide people a lot of the time. You send an email, but originally when it first came out, I had to have AOL and you had to have AOL in order for us to be able to communicate via an email between one another. Now, because of the email protocol, there's interoperability between all of these different siloed ecosystems, and your message just shows up. And that's how it'll be with crypto too. Once they implement these networks, the protocols will just run. Their back end infrastructure that will allow and to facilitate global commerce at scale instantaneously and provide the additional protections and compliance and all that'll be built in. And it's going to take a little bit of time. We're still on the precipice of that, but over the next couple of years, I think that that will make its way into the main stage. And like you said, maybe 3 to 5 years from now, there won't be TradFi or DeFi or crypto. It's just going to be finance. And then there'll be the advent of AI and the implementation of that around, you know, traditional finance. I don't know what they're going to what they're going to coin
Right.
that term
Exactly.
for,
Yeah.
but
Yeah.
it'll be doing automated transactions for you and rebalancing your portfolio and liquidity management and, sweeping accounts overnight, weekends, and holidays into something else that generates a return for you. So you're making money on your money the other 2/5 of the year that you weren't before. It just provides so much better service. And that's what people want at the end of the day. They want more value for what they're currently doing. They want less work and more value. And that's the leverage that
Exactly.
this technology provides people. So I mean, we've got ETFs. We've seen T. Rowe Price launch their blended ETF here recently. Do you have any idea about, we don't have to talk about our products and things that we're working on, but just in general, do you think we're going to see a natural progression of more sophisticated products come into the market from these other institutions?
Yeah, for sure. T Row one is very interesting. That you mentioned that they just launched, like you said, and listed their multi-token
Yeah.
ETF. Most of the ETFs, starting January 11th, 2024, were single token, right? You got Bitcoin, Ethereum, took a while to get those out with staking. There's Solana ones with staking. There's just more. And that list is just growing by the day with many, many issuers, ETF issuers, asset managers issuing them. It's the most competitive ETF asset class market ever. But yes, in terms of the T Row one, that's interesting because that's probably the first that is actively managed multi tokens, spot tokens, physical tokens, right, in an ETF wrapper. So kudos to them for launching that. If you look at the holdings, because it's an ETF, there's transparency. Right back to that point about transparency. There's something you can go on the website and take a look at their holdings, just like any other ETF. You know exactly what they're holding, and it's doesn't surprise me that it's Bitcoin, Ethereum, XRP, Solana. It's just a matter of how they're going to actively shift around the weights to see if that the outcome might be better than just holding, say, the top five on a passive
So
basis.
so their ETF isn't an ETF of ETFs, it's an actively managed portfolio of spot
That's right.
of really? Okay, I figured it would
Yeah.
be a lot easier for a manager to launch a strategy where they just allocate it across other spot ETFs. Now, obviously, that's going to be more expensive because you've got to pay the fees for each one of those products that you're investing in. But for the SEC, I think that's a big step for the SEC to allow for a multi token strategy, which is the bearer asset underneath versus other spot ETFs. Like, I don't think people really comprehend how big a step that is for them because they would most of the time in ETF land, it's a lot easier to launch a product that is an amalgamation of other ETFs that have already been approved by the SEC and filed and have the compliance in place versus going, I won't say rogue, but
Yeah.
holding the underlying assets themselves.
Yeah. No, it's funny how surprised you were, and I was as well, because you might think it's easier to just buy the physical spot but it actually isn't. It took the firm probably a good couple of years to get this to happen because the regulations, uh, let's not forget the U.S. was not the first to get spot ETFs there, unfortunately. At Grayscale, we took years to work with the agency and ultimately had to sue them to make this happen for the entire industry. So I'm, very proud of that moment. But the T row one is in fact direct, and just a year or two ago, that probably wouldn't have been possible because of the rules, and they weren't that clear. So it took some time to work through the regulations to get this in place. Whereas even before the Bitcoin ETFs here, other countries have already launched spot ETFs. But yes, this T row one is direct, and I think that is kind of the point. They would rather do this and not have extra layer of fees, even though it probably is, from a mechanical, operational, portfolio management perspective, easier for them to just launch one that is a fund of funds, right? An ETF of ETFs, because then you just have traditional brokerages where you can just buy and sell. It's actually a lot harder to set this up this way to have direct spot exposure in terms of daily portfolio management and operations. But kudos to them to do this.
Yeah, it is definitely, after being in the industry and doing what we're doing, I can say it's considerably more difficult to do it the way that they're doing it versus just allocating to other ETFs underneath. So, i- do you think it's just going to continue to build derivatives in that capacity, or do you think we're going to see some more innovative products come out around these other types of wrappers? I mean, a lot of the exchanges have functionality and things that the current brokerages that are out there do not. They're starting to get there. Robinhood's been pretty progressive on this. Some of the other exchanges out there and brokers have been as well. Any idea on, you think it's just going to continue to mold together, or do you think that there's going to be anything that's going to stay one side or the other?
Just to clarify that question, when you say it's one side or the other, like spot versus funds, or
Well,
just ETF
like,
wrappers?
I kind of think about our business where we create financial products, but it's on top of the underlying asset. I view us more of like a vault for your gold, but we
Right.
give you additional benefit. Whereas
Yep.
if you're working with your traditional broker, they can make an allocation to an ETF, but you don't have to deal with the underlying spot exposure, how to custody that asset,
Got it.
the additional complications that come along with that, which is much simpler for the average retail person or client to deal with. And maybe that, you know, additional ease is something that will proliferate from here. I guess that's what I'm asking is, like,
Yes,
there
I
are
see now.
people
Yep.
that are very staunch in holding the bearer asset, and then on the other side of the table, there's people that really don't care about that. They just want some type of exposure.
Got it. Yeah, the staunch folks that want the asset itself, let's say gold bugs, right? They want to hold gold physically, whether it's in their backyard or in the bank or somewhere. The interesting thing about that, Jake, is it almost flips it on the head because with gold, it's much harder to hold the asset itself. It's much easier it's to hold the ETF. What we're seeing now is, and this may or may not play out, but I would hope that the tokenized version of anything, it becomes over time much easier to access and trade and manage over time, right? ETFs for now have been the wrapper of choice, right, for the past couple decades, but they weren't always that way. Before ETFs, it was mutual funds. An ETF is just a form of a mutual fund. It's a 1940 Act fund that just allows you to trade, intraday, and the prices are ticking by a millisecond, right? That's a huge innovation in the early 90s, this ETF wrapper. Before ETFs came about, you couldn't get exposure to multiple stocks or bonds or securities at the same time, real time throughout the day. People forget that. But
Wow.
yeah, it was mutual funds. You can only trade them, buy, sell them once a day at 4 p.m., which is crazy, right? So um, it's insane how much innovation has happened over the long run. So I think people underestimate how much can be done, in the long run. But people always, especially in crypto, overestimating the short term, especially when people talk about prices and whatnot. But to go back to your question, I think tokenizing real world assets is becoming a huge trend, and that has been both, stable coins, the US dollar itself, and also, stocks themselves, SpaceX, right? The IPO that was also tokenized before it actually went listing IPO, and the price of the tokenized versions really equally matched when they opened on the stock exchange. So we're seeing the blend, and I think over time, it's going to be a slow grind, I think, for the tokenized versions, the crypto versions, to potentially take over the volumes of the ETF wrapper. Another CIO from a different firm, Bitwise, Matt Hogan, he called, these tokenized versions ETF 2.0, and that I think that's a really great way to describe it. To say, hey, here's a new form of wrapper that can potentially be the new plumbing of our financial system.
So, would you say that you feel like crypto or these protocols effectively eat the traditional financial system, or they blend together to the point where the ETF is a nice wrapper to have because it creates additional functionality and benefit? You kind of view that the same way as tokenization of all of these financial products? Like, that's the new wrapper that allows for additional benefit, liquidity, um, and all the other efficiencies that that creates?
Yeah, it's a very nuanced answer here. So let me try to break this down. At the moment, the ETF wrapper or any security, a stock, still exists, right? It uses DTCC rails, right? The way it settles.
QSIP.
But
Yeah.
yeah, you have to tokenize when you tokenize something like a stock or an ETF. You still have the actual, most of the time, the multiple models, and we're not going to go into details here, but you still have the usually physical BTCC-esque type security on traditional rails, and you're just wrapping it in another layer, if you will, on the blockchain, right? I don't exactly know how this plays out, and it would be really interesting to see over time. But at least in the short term, that's kind of the model that is working. In the long run, it's possible that everything just goes native and run on crypto rails, and we don't need decades old infrastructure to run anymore. Because if you want sub millisecond trading, spreads, liquidity, nighttime, weekends, 24/7, like you said, it probably has to be on crypto rails.
So, you think people will just they will IPO, and their IPO would be tokenized, or they may even issue their equity on private markets in a tokenized format that then transitions onto the public markets, and it's just a seamless experience. It's not a direct representation of another legacy system. Over time, it'll just be one unified system, but it's got to take time to get there,
It's
right?
going to take time, and there's going to be many competing models to get us there. Correct. Just like wrappers, same thing. We still have, most people don't know about this, closed-end funds. They're kind of like an ETF. You can trade them intraday, but their price does not match its actual underlying NAV or net asset value throughout the day. It's a strange thing, right? Well, why is that? Well, they're closed end. You don't get to create or redeem these ETFs, these closed-end funds. So even in traditional finance, there are different wrappers, interval funds and other funds that have different features, but we don't talk about them as much because the ETF wrapper has won, if you will, over time.
Yeah.
Same thing with I think in crypto. Yeah.
It's an interesting statistic that I heard. So I was at an event where they were launching the Texas Stock Exchange last year. We were there with Goldman and
Oh,
NICE
great.
and everybody. And they were up on stage and they talked about how many stocks there were in 1980 versus there are today, and how many ETFs existed. You know that there was zero, right? But
Yeah.
there's actually the same number, or pretty close to the same number, of listed QSIPs that are out there. But in the 80s, it was about 8,000 total stocks that were being traded. Today, there's only close to 4,000 total stocks, but
Yeah.
there's almost 4,000 ETFs
That's
that
right.
are also being traded. So, just a weird transition. And I mean, some of that's to do with, private money and capital markets and the efficiency, and a lot of other things that have caused it less appealing to go public than it used to be,
That's right.
years ago. But um it's going to be a wild ride. Well, if I appreciate you taking the time out and hopping on here. Hopefully, people kind of got to know you a little bit. Anything you'd like to leave people with?
Yeah. Thanks, Jake. Super happy to be here. So you were right in the beginning to say that, this firm, Digital Ascension Group, we're here to kind of democratize, access to this asset class. And I really appreciate you and all the team here for doing that for the entire industry. Uh, it's a very exciting moment, not just for our clients in our firm, but the industry at large, because this asset class is not only something you invest in, but again, it is something that is building the rails of the next financial future. So very excited to see what happens next and the blending of the two worlds of crypto and traditional finance.
Yeah. Uh, it's going to be a fun ride. Well, thanks again for joining us. Thank you, Lewis, for being here. Like I mentioned at the beginning, if you wouldn't mind, if you got value from this, please like, subscribe, share. It helps the algorithm in the channel. Wish you guys a wonderful day or, you know, weekend or whenever you're watching this, and we'll see you on the next one.